And on today's show, how to use the forgotten products for retirement security. Part 4 of this week's series on Don't Worry, Retire Happy from Tom Hegna's public television special with nationally recognized author, platform speaker, and retirement expert, Tom Hegna. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to InsMark, Live Specs, and Backroom Technician. Let's get down to business. Well, welcome to the show, Tom.
Hey, great to be here, Steve.
Well, we're talking about the forgotten products. I cannot tell you, and this is a truism, I get to look at a lot of retirement plans. People are always asking us to kind of take a peek at it, our sponsors, into this very big. And I look at it and I'm always surprised, how come I don't see any long-term care or extended care coverage in your plan? And on top of that, these people have serious longevity in their family. And we already know that age 65 and above, 70% of some kind of extended care or assisted care living is going to be necessary. And I think as we live longer, it's just going to exacerbate that number.
Yeah. I say no retirement plan is complete without a plan for long-term care. It's the one thing most seniors forget about that can wipe out their entire life savings. If you think about it, what else have you not planned for that could wipe out everything else you've ever done on the face of this planet? It's the one thing that's so critical that needs to be taken care of. You know, I say a lot of people think that retirement is 30 or 40 years of golf, tennis, line dancing, and cruises. That's not true. You're going to go through 3 distinct phases, Steve. You're going to go through them too.
Oh, boy.
And the first phase is what I call the go-go years. Now, in the go-go years, you're playing golf, you're playing tennis, you're going on cruises, you're line dancing every day. It's happy hour somewhere. That's the go-go years. But the go-go years are going to be followed by the slow-go years. Now, in the slow-go years, you can still do everything in the go-go. You just don't want to anymore. In fact, you don't want to go downtown after 4:30 because Dad can't see when it's dark out. That's the slow-go years. Now, the slow-go years are going to be followed by the no-go years. Now, the no-go years, Steve, are when you're probably not leaving the building till you're leaving the building, if you know what I'm talking about. So, go-go, slow-go, no-go. Now, the reason it's important to understand this is because you want to spend more of your time traveling and doing the things you can in the go-go years. And then you got to remember, there are going to be these slow-go, no-go. You got to plan for that, and that's where the long-term care comes in.
Okay, so when I'm looking at this, and I'm introducing this to a consumer because I think a lot of our advisors, especially security-oriented advisors, have not really looked at long-term care because they think, oh, I'll just self-insure for that. I've really done a good job accumulating assets.
No, you cannot self-insure. And if you do, you're not doing it the optimal way. Then I tell people, if you're going to self-insure, then cancel your homeowners, cancel your auto, cancel your health insurance, because you got a much better chance of using your long-term care than you do of using your home or your auto. But why aren't you self-insuring your home? Why aren't you self-insuring your auto? Why aren't you self-insuring your health insurance? It doesn't work that way. This is a way that you can, for pennies on the dollar, take off a huge risk off the table. So let's get into it. The odds of your house burning down are less than 3 out of 100 for the rest of your life, and yet you all got homeowners insurance. The odds of you totaling your car between now and the day you die are 18 out of 100. You all got automobile insurance. But the odds of you needing long-term care between now and the day you die, as Steve said, is 72 out of 100. And yet, if you look, out of all the people that are 45 years in age of older, less than 30% have taken long-term care off the table. Now, here's what I say. Any plan is better than no plan. And as you know, Steve, there are life insurance policies that come with long-term care benefits. There are annuities that maybe are paying $2,000 a month. If you need long-term care, it jumps to $4,000 or even $6,000 a month, and you don't even have to qualify medically for some of those annuities. So I say any plan is better than no plan, but you got to have a plan.
So I could have accelerated benefits on a platform like Life and Annuity. I might even have a rider on one of those chassis. Or some people say, well, they always ask me, Steve, is the long-term care standalone policy a better deal than a hybrid policy? And my thing is, how long are we going to live, and what's the dollar for benefit value?
Right.
And that's always going to be the question. In your mind, when you're talking to advisors and you're converting them, because actually this is a conversion issue. Many of our security advisors who have really good planning expertise are not looking at this, and they're exposing their their clients' assets to undue liability. And when you look at 72%, that's big.
Yeah. Don't tell me you're in the retirement planning business if you're not recommending long-term care. You are not in the retirement planning business. You got to take that risk off the table. It's a huge risk. Let me just tell you about my own parents. Okay, I literally made them buy policies about 16 years ago. They didn't want to. They thought they were too expensive. They're never going to need them. They didn't buy them from me. They bought them from Bankers Life up in Minnesota. That's what they did. But guess what? In the last 60 days, they both gone on claim for long-term care. And those two policies are going to allow them to live a great lifestyle for the rest of their life, that if they were just trying to self-insure, they would be running out of money. I mean, Steve, this long-term care is beastly expensive. I'm getting the bills now. It's unbelievable how expensive this stuff is.
Well, when I look at the numbers now, isn't it true? And you said having something is better than nothing. But when I'm looking at the longevity, your parents thought back in the day that they would never see these kind of numbers.
Right.
They would not be this old. And I think we need to start thinking this is the way it's going to be.
Right.
We're going to be looking at huge longevity.
So when my parents were growing up, the life expectancy was age 76. Well, now it's age 85, 88, age 92. But guess what? We're going to be living to 100 because every generation thinks they know what life expectancy is. That's life expectancy for the people who are living now. That's not the one for when people live longer.
When we think about longevity, we're going to have to talk about life insurance. And we come back from the break, we're going to talk about a forgotten product in retirement. We're going to talk about life insurance. We'll be right back. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. We're with Tommy Hegna. Tom, we're still talking about your book that you did in this PBS special. What an excitement for you. But this book is fantastic. Don't worry, retire happy. Talk a little bit about it.
Yeah, so there's all each of the 7 steps has its own chapter, okay? So there's those chapters. There's the chapter on tips for women, tips for the LGBT market, there's tips for late savers, there's a whole chapter on longevity credits, there's a whole chapter on the importance of life insurance in retirement. There's also a DVD of the TV special, which advisors have found if they have the clients watch the DVD, read the book, they can fill out the applications. There's a bonus DVD on guaranteed income and the importance of life insurance. There's a 2 CD set on long-term care and Social Security. There's an audio book, and then there's a Social Security guide. So what I try to do is put together a kit that every advisor or every consumer would need to retire successfully, and it's all right there.
Well, this is a huge opportunity. And again, you can go, what website can they go out to look at?
RetireHappyNow.com. They can pick it up on Amazon or at my website, TomHegna.com. So any of those.
Well, when I think about life insurance, I usually quarantine it to, hey, this is another tax diversification item. Right, when I'm thinking about life insurance and income. And now all of a sudden it's becoming somewhat popular even in the secular press. Talk about life insurance in retirement.
So a lot of people think life insurance has nothing to do with retirement. I say life insurance has everything to do with retirement. See, it's the permanent life insurance you bring into retirement that gives you the license to spend your money. If you think about one of the reasons why people live this just-in-case retirement is because in the back of their minds they keep thinking, I got to leave some money to Johnny and Susie, got to leave some money to Johnny and Susie. So what I say is one of the first questions you ought to ask the client is this: how much money do you want to leave to your kids? And then that should be life insurance. See, what we did, my wife and I, we figured out how much do we want to leave to our kids. We want to leave them some, we don't want to leave them too much, too little. And that was the amount we picked. We bought life insurance. That goes to the kids. Guess what that frees us up to do with all the rest of our money? We can spend it. We don't have to live this just-in-case retirement anymore. Now, Steve, I know you recently wrote a big paper on life insurance and put all these different types of policies on one page. Tell a little bit about that.
Yes, we actually developed a model for Innsmark, one of the top planning softwares in the United States, where we compare the 4 chassis together: par whole life, current assumption UL, index UL, and variable UL, all on the same platform to see which one do you think will work for you. And of course, we do a risk tolerance test to make sure we're choosing the right chassis. Yeah,
so what kind of do you find? Does it make difference which kind of person, what their time frame is?
It does. Of course, I'm in love with females who are super preferred because the cost of insurance is so much cheaper on them. Right. But I also need about a 10, maybe 12-year minimum to really make this work in retirement.
Yeah. So look, here's some of the things I did. I try to keep it simple when it comes to life insurance. You know, what's on your keychain? Well, typically you have your house key, you have your car key. Well, guess what? You insure your house, you insure your car. What about you? You know, when I talk to property and casualty agents, I say, look, you've got a full replacement policy that if their house burns down, you're going to come in here and build them a new house. You have a full replacement policy that if you total your car, guess what? You're going to bring them a new car. Do you have a full replacement policy on the client? And I say you need at least $1 million of life insurance for every $50,000 of income. People don't know what this low interest rate environment has done to their life insurance. You need at least $1 million for every $50,000 of income to even come close to having a replacement policy on you. So there's a couple ways that you can calculate how much life insurance you need. You can do what I just did, $1 million for every $50,000 because we're in a low interest rate environment, or you can do a human capital full replacement model. Now I'm going to go through this kind of quickly, Steve, but this is the human capital model. Your human capital is the present value of all your future earnings. So if you're young, you got a lot of years of future earnings. If you're old, you have fewer years of future earnings. You add that to your financial capital, and that's your total economic wealth. Now, Steve, most advisors are only talking to people about their financial capital. But for younger people, their human capital is worth far more than their financial capital. And our job in our life, Steve, is to take our human capital, our earnings, and turn it into savings and investments into our financial capital. So you could imagine younger people have more human capital. But as they get older, their human capital goes down, but hopefully they're saving and investing and turning that into financial capital. So young people have more human capital, less financial capital. Older people have more financial capital, less human capital. Well, it just happens that life insurance is the only thing that can protect your human capital.
Now, when I'm looking at the mortality risk, I understand that. People say, hey, listen, I want to have my spouse not be obligated for my debt and the house payments and so forth. But when we're talking about it here, this could also be a tax diversification issue in retirement. We always talk about this bridge getting to Social Security. People are still using their actual permanent cash value policies to pull this off.
Absolutely. So your permanent life insurance can be withdrawn tax-free. So what a lot of people are doing is they're pouring extra money into permanent life insurance. Yes, it gives them life insurance protection, but they're building up the cash value so that in retirement they can take that out tax-free. And that's called tax diversification. You can also, a lot of people think that older people don't buy life insurance. That's not true. Older people, people over the age of 60, buy more life insurance than people under the age of 60. So let me just give you a couple quick hits what you're looking for. Number one, talk to them about their grandchildren. They may not like their kids anymore, but they love their grandchildren. So if they really want to leave money to grandchildren, life insurance. If they want to give money to charity, life insurance, because they can give more. I tell people, don't give money to your kids. Don't give money to your grandkids. Don't give money to charity. Give life insurance. You know why? Because you can give them so much more. Spend your money, give life insurance.
Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just go out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant. We'll see you tomorrow.